Hello everyone. Hello everyone. Thank you for joining us for the webinar today. I am your host Anna D'Souza from Yes Securities, and today we'll be discussing market outlook and the top focus funds of ICICI AMC. Sounds like fun, right? So by the end of our session, we hope you can build an edge by learning more about the investment opportunities and the current market outlook. So that we hope that you can make individual decisions, informed decisions by yourself. So all of us here are very passionate about today's agenda and have many exciting stories and learnings to share with you. So, keeping that in mind, let me introduce you to our guest speaker, Mr. Bhavesh Sharma. Uh, Bhavesh is a fund manager from ICICI Prudential Asset Management Company. Bhavesh has a very rich experience in risk profiling and product development. He has conducted various, webinars and training sessions all across India. So, thank you for joining us, Mr. Bhavesh.
Thank you so much, Anna, for inviting.
So, so before we can proceed any further, for the audience who is watching us live, if you have any questions during the webinar, would request you please type them out in the chat window. We'll address them during the Q&A at the end of the session. So, so that we don't have any disturbances. With that, I would over to you, Bhavesh. You can proceed.
Okay, great. So, thank you for this opportunity, and I hope everyone has logged in. So, as you can see, that we'll be discussing a little bit on the market outlook today, and we'll also look towards the focus products that we at ICICI Prudential Asset Management are feeling that can help our investors build long-term wealth, and they can also help our investors navigate the current volatile market. So, market outlook for May, when we are sitting here and we are looking from Indian perspective, it looks much better than I would be dreadful to look at from any global perspective today because we hear a lot of news. So what we will do is we'll filter out the noise and we'll just look at the facts and figures because ultimately that is our job. People can have various opinions. What we look at is data and fundamentals of the place where we are investing. Based on that, we'll make our own decisions, and the funds that we will be recommending also is aligned with our objective. So if you look at the presentation, you will see that in India, the last 2 months, there were a lot of things that was happening. So it was a roller coaster ride, which started with the fall of Silicon Valley Bank. So in the March, we saw this news where two major banks in America, Silicon Valley and Signature, they had a fall, and there was a lot of impact on Indian equity market in terms of the fall in share prices, not in fundamentals, not at all. But yes, in terms of share prices, yes, there was a fall. Then it was followed by another major global bank called as Credit Suisse, where again we saw a lot of bad news around, and then the impact was naturally there on our market. So in this entire period, we see that power gave an absolute returns of approximately 9% in this month, and which was followed by around 4% in infra, 3% in oil and gas, 2% in energy. If you look at the trend, what we are seeing is that the sectors which are more domestically inclined did very well, but the sectors which have some or the other influence globally, for example, IT, did not do that great. And this has been the story from 2021 October onwards when we saw the flat market scenario beginning, when we last saw FIIs entering a market in a big way, where after which the liquidity crunch began, started by Federal Reserve. So in this period, we saw power infra doing very well. Then in the month of April, again, we saw there was a bounce back after the fall in the month of March, and we again reclaimed the level of 60,000 in Sensex and approximately 17,600, 17,800 range of Nifty. So what is happening? Why does these things happen when there was a fall? Then after that, how do we see this particular recovery? Is it temporary in nature? Can we expect another fall? There are a lot of questions going on in the investor's mind. Many people feel that this is just temporary. For long-term investors, I'm sure all these things doesn't matter because it's very short-term. But for people who like to be updated on the market, here are some of the slides why I'm going to explain that India's growth may stay resilient going forward as well. So, like I said, we are fortunate seeing this particular thing from the Indian perspective because what we see in India is growth and more growth and more growth. So we are seeing a good amount of growth in India even after the COVID fall. So India was one of the economies which recovered the fastest from COVID, which had the least impact due to the COVID thing. And that is the reason why we are in a great shape today. Some might argue that we are in a better shape than we were pre-COVID. And you can see the reason why with the slides that I'm going to show. First, if we look at the capital expenditure that has increased post-COVID, so there has been a lot of money pumped in the infra space, in the capex space, in the building of roads or railways, new setups of factories, defense, all these areas, and we can ideally see that this can continue for maybe 1 or 2 year more. A lot of expenses towards capex will lead to good amount of growth in the job market as well, because this is one of the highest employer in the country. If we look at the working age population or the demographics of the country, we can see that there is a steady increase, and going forward for the next 20 to 25 years, we see that the working age population in India would be more than 50% of the entire population. And this is what every country wants. They want a demography which can support their growth, because larger number of people in the working age means more people who can earn more income, and more income means more spending, then ultimately the cycle rotates, and that means more demand and more growth for the economy. So if anyone wants to invest in any particular economy, it would be an economy where there is good amount of demand and sustainable demand. As you can see from the graph on the left side, there is a sustainable demand that we can see, because the population will working age population will be high till almost 2050. So right now we are in 2023. I think we have good 20-25 years before we start worrying that will we go the Japan way, or will we continue to rise going forward. Now the right side chart gives you very interesting information. If you look at the products over there and the penetration in India of these white goods, you will realize that we are kind of living in a bubble when we live in big metro cities like, say, Mumbai or Delhi, and we live in bigger towns, or if we ourselves are affluent or in the upper middle class and our group is similar, then we find that most of the white goods are available with everyone. So we see that every second person has a car, or every house there is an air conditioner or refrigerator, smartphone, TV for that matter, all these things. But when we look at the entire country, when we look at 140 crores population, then we see that the penetration is not quite there. There is still a long way to go. If you look at India in the auto space, only 4% penetration. When you compare it to China, almost 15%. So almost four times of India. And when you look at USA, it is at staggering 81%, which is too much high compared to our country. If we aim to be the next China, we need at least 4x. If we aim to be the next America, then yeah, you can see that we have a long way to go. That means that there is more demand expected, more auto to be sold in India in the next 20-25 years. Still, our working age is doing very fine. If we look at the foreign trips that we take in our country, so it might be very common thing that we are going abroad, we are going to Dubai or Singapore and places like that. However, it is not as common because only 6% people have traveled abroad out of India. Compare it to China, it's 9%, and US, yeah, again 42%. It's way high. Air conditioners, do you feel that everyone must be owning an AC today in today's life? Then you might be wrong, because only 8% people have AC at their homes. Compare it to China, it's 60%, US almost 90%. Refrigerators, I think many people might consider it as one of the essentials at home, and only 18% people have that. whereas in China it's 94% and in US it's 100% perfect. Every house there is a refrigerator. You will see this differences in goods like TV also, in goods like smartphone also, which we feel that it's very common today. But if we look at from perspective from the 140 CR people, no, it is not that common. Not everyone has it. Maybe your friends have it, maybe your group has it, but not everyone in India has this. So what we see here is not that we are lacking behind. What we see is the scope of growing, going forward. Now let us look at the health of economy also. If I'm talking so much about India growing ahead, then we also need to see how good the health of economy looks, right? So left hand side, the chart will show you that banks have repaired their balance sheets. So there was a gross NPA level of approximately 12.4% in 2018. So 2018-19 was not a very good year for banks, but gradually it has declined. They have cleaned their balance sheet, they have restructured their loans, and it looks much better today, even better than the pre-COVID levels or better than the 2014 2013 taper tantrum levels. If you look at the corporate debt as a percentage of GDP, again it was at peak around 62% in 2014-15 era, and then post that it has gradually declined. So the debt has been used in a much more efficient way, and today it is only at around 49%, which is good enough. So India has done a lot of changes. There has been measures taken in the last few years, be it production linked incentives, be it the insolvency and bankruptcy code, which was introduced to keep in check the NPAs, be it the land reforms, the taxation reforms. One of the best things that can happen to a corporate is that their taxes are reduced, which happened in the last few years. So all these things have helped our country to grow in a good way, in a sustainable way, and it can continue to do so going forward as well. Now, what are the other things that is helping us from the global perspective? Once the COVID came into picture, we got an opportunity called as China plus one, because there were many countries who were hesitant now to go and invest more in China, develop in China, manufacture in China. Similarly, when Russia-Ukraine war began, we got a Europe plus one opportunity where Europe was facing energy crisis in a big way, and they couldn't manufacture in a big way, or their energy couldn't be shared with the industries, because it was very necessary that the energy was conserved for the people so that they can survive the winter, the cold harsh winter of Europe. And all these things gave benefit to India, it gave opportunity to India. Why? Because look at the manufacturing wages in India per hour basis, the left hand side column, and you will see in the last 3 years there has been hardly any increase in the wages of labor. So India is still one of the cheapest market to manufacture in the entire world. Even if you compare that to China, China is much expensive, or for that matter even Thailand or Vietnam has higher wages on an average than compared to India on a per dollar basis. Now, although this doesn't seem good from the perspective of laborers that they are getting paid less, but if I'm a MNC, if I'm a foreign company, and if I want to start manufacturing in any other country, then I would like these statistics that I can start my manufacturing plant in India and I can save on a lot of labor costs. So as a result, you can see on the right hand side, there is a list of companies who have come to India in the last few years, who have pledged that they will be investing in India, putting in more money, setting up manufacturing plants. And this means that more jobs for Indians and better wages compared to the Indian companies, what they pay. So there are big names like Samsung or Foxconn, Siemens, Nokia, Flextronics, and then there are some common names like Nestle, HUL, who are keen to invest more in India in the manufacturing segment. If we look at the digitalization boost that we have received, then the UPI transaction says it all. Say just 5 years back, UPI was just beginning, and there was hardly, the transactions, they were merely casual in nature, wherein we were just behind the cashback that we would get in the Google Pay. We would just send it to our friends so that we can get some amount. But then slowly it began to replace as a form of payment. It's and as quickly the people adopted, even the smaller stores, even the people driving taxis or rickshaws, even your local kirana stores, as soon as they started adopting it, it became a very prominent medium of payments. And you can see the rise. It is exponential from 2017, where the total transaction amount was around 1 lakh crore. You can see in 2022 it crossed 126 lakh crores, and it is growing similarly at a very exponential pace. If you look at the rise in payroll, so this is another data in the EPFO segment. So most of the corporates, they have this EPF for their employees as a benefit. And if you look at the new subscribers, approximately between April to November 22, there were 13 lakh more subscribers. So that means more people are getting jobs in proper structured corporates, and they are getting this benefit of EPFO as well. Another very interesting thing, and I think this has been the talk of the town, because another data just came up few days back, which I have not updated in the slide, but I'm sure everyone knows that we crossed 1.8 lakh crore mark in the GST collection in the month of April. And how amazing is that? Because just a year back, we were struggling to cross 1 lakh crore. And now, from almost 11 months consecutive, we have crossed 1 lakh crore. Not only 1 lakh crore, but we are reaching new benchmarks. We are creating new highs from 1.3, 1.4, 1.5, 1.6, and now 1.8 lakh crore is the new high that we have reached in the GST collection. Why this data is so positive? Why it gives me a lot of hope, positivity? Because tax is something that no one likes to pay additional or extra. We always like to save our taxes as much as possible. But if I'm trying my best to save taxes, and still if there is a record collection in the taxes, that means that I am earning good, my revenue is good, and no matter how much I try to save, I still have decent earnings that I have to pay 1.8 lakh crores. So that means that we have good growth and demand, revenue is great, and it's a positive sign for any economy. And provided that there has been not much of a change in the tax rates as well, in the GST rates as well. So it's a very good data to see and to follow going ahead also. So I am not expecting 1.8 lakh crores every month, but what we are seeing is a good consecutive more than 1 lakh crore collection, and sustaining at 1.3 lakh, 1.4 lakh on a month on month basis is a very good news for the country. Now let's talk about valuations also, because most of the data that we saw highlights a lot about India as a country going forward in a longer period. But what about today? Is it a good time to invest? Should I start putting in money today itself? So we'll have to look at the entry point. We'll have to look at the valuations. So if I look at the valuations today, then the P looks reasonable around 2021. So the last month rally has increased the PE to approximately 21, 22 range, but still it is not very high. It is near the average. If you look at the average in the last 20 years, it is approximately 21. Similarly, if we look at the price to book value, the average is approximately 4, and we are currently very close to 4. So you can say that we are very close to the fair value today. So it's not a very bad time, I would say. If it's not the cheapest of the market, but it is not the most expensive one. We are not in the October phase, October 2021, when the markets were very, very expensive. That is October 2021. We have corrected a long way from that. If I look at the data from October 2021, how the markets have, how the stocks have corrected or increased, you will look at this data. It's very interesting because you will find that most of the stocks, or 67% of the stocks overall in the NSE 500, has delivered less than 0% return. So that means they are in the negative territory in the last 20 months. So their high was 20 months back in October 21, and from that level, 67% has corrected. If I look at the large cap space, 65%, mid caps, 64%, and the small cap almost 69% are below their all-time high in October 2021. So there has been definitely some of the stocks which have done well in the last 20 months, but large portion of the market remains below their highs, which is again a good thing for an investor who is entering now, because he will get at a much better, or she will get at a much better rates. If I look at our valuations from global perspective, what is the premium that India is getting today? So you can see the left hand side chart. Please don't get confused if the chart looks a little bit daunting. I'll try to simplify as much as possible. So if you look at the left hand side chart, the average PE premium that India as a country get over the emerging markets, it is 62, and currently we are trading at 66. Again, we are very close to the average. It had gone to as high as 132 just 20 months back. So the reason why I'm telling you the high also, so that you can understand the fall in the valuations that we have seen in the last few months, and you don't perceive that today also the market is at very high level. If you look at the right hand side chart, and you can see the premium over Asia excluding Japan. So again, all the emerging countries of Asia, you can see that the current premium is approximately 38, which is lower than the average premium that India enjoys. So we can see the valuations look good from the global perspective also, which were not quite there few months back. And if we look at the absolute returns to solve everyone's doubt, how does India look today? If we compare it with the entire world, you can see that in the last 20 months, India has delivered hardly 3% returns, whereas most of the countries in Europe, where there was a major crisis, their growth is slowing down, their demography is not in line, their working age population is reducing, there is a war going on in that particular continent, they have major dependency on Russia. In spite of all those factors, you can see Germany growing almost 30% in the last 20 months, France growing at 27%, Eurozone, entire zone growing approximately 22%, China, which was locked down for major part of the last 3 years. So you can see Hong Kong has still grown 18%, Taiwan and China, which were on verge of war, there were a lot of tensions, has still grown 18%. US, where we see a mild recession, has still grown 16%. And India, in spite of all the positivities, if we are at 3%, then I think that says it all, that we have a good growth pending ahead, because most of the valuation issues are behind us. We are not that expensive today. Fundamentally, we are looking great compared to all these other countries which have grown. So we can maybe see a comeback of FIIs as soon as the Federal Reserve, they stop hiking the rates. So to summarize everything, the entire market outlook, what you will see here is that our equity valuation index, it's very easy to understand. Just look at the colors and remember traffic signal in your mind. So when the traffic signal is red, what do? We stop. And similarly, when our graph shows the red zone, we will stop investing new money into equity. Whenever the traffic signal is green, we start. So over here also, when the graph comes in the green territory, we have to invest more into equity. It's a good valuation zone. And the yellow area is the cautious zone. So look on the both sides of the road before crossing. Similarly, over here is the neutral territory. There are some patches where you will get good returns. There are some patches which could be expensive as well. So currently it is very close to the green zone. In fact, in the month of March, it had touched green zone for an entire week. Now also it is very close. Maybe this continuous volatility will get more opportunities to invest in green or closer to the green. So another fact, that whenever you invest into this green territory, and if you stay invested for at least 3 years, and I'm talking about Nifty 50 here, a general benchmark. So Nifty 50 investment, when our index shows green, and if you stay invested for 3 years, in the last 18 years, it has happened that the chances of you getting double digit returns is 89%, which is super duper high. So almost you can say that whenever it's the chart shows green, and if you invest in Nifty 50, the next 3 year return you should be in double digit. And If in equity, I'm sure that most of you invest because you expect higher returns, because for single digit we can invest in bonds or FDs as well. So I think it's a good sign, good indication that yes, you can start investing in equity meaningfully from the current levels. It is not that expensive. Now, when we talk about scheme recommendations, since we have summarized the entire market outlook, if we look at the scheme recommendations, definitely you can invest into equity, but as we are slightly in the neutral territory, the best recommendations will be towards the asset allocation side, towards the hybrid kind of investments, which can give you the flavor of equity. At the same time, it can help you reduce the risk, reduce the volatility that you get in an equity market. So, which are those recommendations? I'll just give you a brief about them. So these are the numbers of a typical investor. These are domestic investors' inflows and outflows. When we see the markets were at higher valuation, for example, in September 2018 or August 2017, these are the periods when the markets were at very high valuations. We saw that the domestic investors put a good amount of money into the market at higher valuations. Similarly, when the valuations were really low and attractive, like between the 2013 to 2014 phase, at that time we saw most of the domestic investors pulling out money and exiting the market. You can see the inflow and outflow numbers also, it's in thousands crores. So Warren Buffett has said that be fearful when others are greedy and be greedy when others are fearful. And I think we domestic investors, we do something different. We are greedy at higher valuations and we are fearful at lower valuations. And I think this is the common case with all the investors. But what is the solution to all of this? Because ultimately we are not here to discuss problems only, we are here for solutions as well. So we need a solution to understand when should I invest in equity, when should I move towards debt, what is a market high or what is a market low, when do I entry the market or when do I exit the market, if I redeem now and reinvest on a later rate, will that be better or should I stay invested continuously? So there are a lot of questions in a typical investor's mind. So we did a study internally. This is a study of asset allocation, and this study is based on actual journal in 1991. The journal the name of the journal is Determinants of Portfolio Performance, which was published by two gentlemen. They did a research on asset allocation, that how important asset allocation is. And if you look at the chart here, this quite sums up the importance of asset allocation when it says that 91.5% of your portfolio returns come from asset allocation. Hardly 4.6% come from the security selection. Hardly 1.8% comes from the market timing. We all love to time the market. Is it the best time or not? But it hardly impacts 1.8%. And then the other factors like the rupee currency, crude oil, and other macro factors, it hardly impacts 2% of your portfolio. So that means if I just get my asset allocation right, if I am in the equity when when the equity is about to rally, or if I am in the debt space when the debt can do better, if I just get my asset allocation right, then 91.5% of my portfolio returns are sorted. How to do that? It is easier said than done, because there is a lot of challenges. How frequently will you rebalance your portfolio if you are doing it by yourself? If you are buying FDs or bonds, if you are buying equity shares, and if you are trying to do the rebalancing, how frequently will you do? Will you do it every month, every quarter, every 6 months? Then there will be operational hassles, paperworks, doing moving money from here and there. There will be exit loads. There could be taxations on each transaction. Can there be an easier way? So I think you know the answer. If I'm asking you this question, I'm ready with a solution. And yes, there can be an easier way. So we have three options today that I'm going to tell you about. Easier way of doing the asset allocation on a dynamic basis without you worrying about operational part or taxation part or exit load part or any of these. So over here, what we have is the first solution, that is based on price to book value model. So this is an in-house model that we have created. This model works largely on price to book value, but there are other parameters also that we consider. How does this model work? It sell when the equity valuation goes up, and it buys when the equity valuation comes down. So buy at a lower rate and sell at a higher rate. Again, sounds too easy. How does this fund does? It does on a in-house valuation model. This fund is Balanced Advantage Fund. It's ICICI Prudential Original Balanced Advantage Fund, which we started in March 2010. The model that I'm talking about. It is the first Balanced Advantage Fund in the AMC in the entire industry. It is so brilliant that SEBI created a category called Balanced Advantage in 2018. So I think that is the best compliment you can give to a fund if you manage to impress the regulator with it. And we have seen trust of the investors in this particular fund in a big way in the last 13 years, as this fund is one of the highest AUM fund also, with more than 44,000 crores of AUM. Now, what does this fund do? It manages equity and debt in a range. So equity range is between 30% to 80%. This is the net equity range. And the remaining we put into debt. We only use large cap and some amount of mid cap in this particular fund. So we do not go to small cap, although it's a flexi cap kind of category fund. And in the debt space, we follow accrual strategy. So balanced advantage equity level is something which is rebalanced on a daily basis. You heard it correctly. It happens on a daily basis. It might be not feasible for me as an individual in my own portfolio to do rebalancing on a daily basis. But yes, our fund is able to do this particular thing from the last 13 years. And as a result, impressive performance. So what you can see in front of you is a chart of our average equity allocation during various levels of Sensex. For example, between Jan 2019 to Jan 2020, or you can say March 2020, just before the COVID, the average equity levels were only 49%. That is before the COVID. After COVID, we increased the equity levels to capture the low valuations, and average equity was 61% in the COVID period till January 2021. Post Jan 21, when the markets again reached new highs, valuations were up. After that, you can see we dropped our equity level, and the average equity from Jan 21 onwards till March 23 is hardly 36%. But again, like I was mentioning in my market outlook, that the valuations have improved a lot. So the equity levels as on March 31st had crossed 50% again. So we have increased the equity levels again because we saw the valuation coming at a very good level today. This is an example of how this particular fund has managed to generate positive returns even when the overall Sensex or Nifty has remained flat. So you can see the periods where your 40,000 market came back to 40,000 after roaming here and there, or your 50,000 market came back to 50, or 60,000 market came back to 60,000. And the period is not a small period, it's 1 year, 1.5 year, or 2 year periods as well. The absolute returns in Sensex in this period was around 0%. However, in Balanced Advantage Fund, we managed to create positive returns on an absolute basis in this entire period. So it is not just about creating returns when the equity is rallying up. Even when the equity is flat over a period of 1 year, 1.5 year, still we manage to create returns because of the dynamic allocation. Because we buy at a lower price, we sell at a higher price, we buy at a lower price, we sell at a higher price. We do this on a daily basis. By doing this, we are able to create returns even in a flat market scenario. So if you look at the financial years from 2010 till 2023, every year, whenever the Nifty rallied, we also gave very good returns. Every year, the Nifty corrected, we corrected less than Nifty. In certain cases, Nifty was negative, but we were still positive. And if we add up everything, the entire rally from 2010 to 2023, what you will find is Balanced Advantage giving a return of approximately 11.5% CAGR, and Nifty 50 in the same period generating around 11% CAGR. So what we are doing is we are beating a pure equity benchmark in a longer period. It's not even a short period. In a longer period, we are beating a pure equity benchmark, but that is not enough, because that is not my aim. This is not a fund maximum return generating fund. This is a fund where my risk return is efficient, where I take less risk but still manage to deliver a good amount of return. So now look at this particular graph closely. We already saw that Balanced Advantage has managed to beat Nifty 50 in a longer period, in a 13-year period. However, as I said, my aim is not to beat Nifty 50, it is to take least possible risk and deliver good returns. Now look at the equity level of Balanced Advantage in this entire period. Average equity highlighted in green box, it is only 52.5%. So to beat Nifty over a 13-year long period, the average equity that we used is only 52.5%. So we did not require 60, 70, 80, 90, 100% equity to beat a 100% equity benchmark. That is what the fund is all about. That is the reason why it gives very good experience to the clients, because it shows less volatility, less negative experience, more than inflation returns, more than bonds and FD returns, and in this case, in a longer period, more than Nifty 50 returns also. What more do you want as an investor if I'm able to generate an equity kind of returns by taking almost half the equity? And I think that is where I rest my case for Balanced Advantage Fund, why it is necessary for every portfolio, part of a core portfolio in the investors uh, investment thing. And similarly, we have created more solutions for the investor. So like you can see our in-house equity valuation index, which I just explained, we have another solution which works on this particular model, and that is called as asset allocator fund of fund. Now this is a fund of fund, it is not a fund, so it is a slightly different from Balanced Advantage, although the concept remains similar, that we buy at a lower price and sell at a higher price, but we do it with the help of equity and debt funds rather than stocks. Over here, the range is also different. In Balanced Advantage, the equity range was 30 to 80. Over here, the equity range is 0 to 100. And similarly, in debt also, we can go from 0 to 100. So over here, you will find that we can move in either side. We can move completely towards equity or completely towards debt, depending upon what our model is suggesting. So if the model is in the red space, then definitely will be very high towards debt. If the model is in the green space, then will be very high towards the equity. Again, if we look at the equity levels in this particular fund during the last 4 years, so pre-COVID, the average equity was only 34%. So again, that makes sense. So when there was a fall in COVID, we corrected less because our average equity was very less. But as soon as we reached the lower valuations in the COVID period, our average equity increased to 67%. So in Balanced Advantage, it was 61%. Over here, it was 67% because we have a more leeway. Our range is bigger and more flexible over here. And average equity after the COVID began normalizing, it is 33% only. So again, because of the last 1 2 months when we have seen the valuations improving, the equity level has increased to close to 50% now. The average equity for this almost 1.5 year, 2 year period was around 33%. So we are increasing the equity levels here because the valuations look better. If we look at the similar data like we saw in Balanced Advantage Fund, over here also you can see that we have managed to beat Nifty 50 in this entire period. However, again, I will not focus much on the return because return is something that cannot be predicted. It can change. But what I would like to highlight is the risk that we have taken. You can see the average equity level over here is only 41%. To beat Nifty, I required only 41%. So again, a similar fund like Balanced Advantage, which uses less equity but has managed to deliver a superior performance. So a solution for every client in in their portfolios. Now, one more thing that is different in asset allocator fund, it can also take help of gold. So Balanced Advantage cannot invest into gold, but my asset allocator fund can invest into gold ETFs. So it also can generate returns from gold from time to time. There is no compulsion, but yes, it can do that. Another fund which can take gold, another fund which can invest into equity, debt, and many other things is called as multi-asset fund. So in front of you is the returns of equity, fixed income, and gold from time to time every year from 2007 to 22. So last 15-year data you have in front of you. The green color symbolizes which asset class gave the highest return in that particular year. Red color symbolizes which asset class gave the worst return in that particular year. And yellow color symbolizes a moderate kind of return scenario. And you will find that although most of the years equity was in green, but then there was certain years where you required gold as well, because between 2016 to 2022 there are multiple green periods in gold. Similarly, between 2008 to 2011 there were multiple green periods in gold. So gold as an asset class has the potential to deliver higher returns than equity in certain times. So if I completely avoid gold, then I might be missing some of the returns. So we have two funds which can participate in gold. One I have already explained, asset allocator fund. Another fund is called as multi-asset fund. As the name suggests, multi-asset, it can invest into multiple asset classes. So it can invest into equity for capital appreciation mostly. It can invest into debt for stability, for higher accrual returns. It can invest into gold. Gold can act as a hedge against inflation also, hedge against recession also. And last is real estate investment trust, infrastructure investment trusts. All these are yield enhancement strategies which can give you that additional 0.5%, that additional 1%, and definitely that will add on your overall portfolio. So there are multiple things that we can do in multi-asset fund. And overall, this particular fund is very old, from 2002. It has around 17,000 crores AUM, and it is one of the highest returns generating fund in the hybrid segment. Since inception, return is more than 21% compounded in the last 21 years. So it has delivered higher returns than even equity in most of the cases. And even recently, in the entire COVID and post-COVID period, multi-asset has been very impressive in generating returns. Again, I would say that we should not only focus on returns, but also look at how the fund is being managed and what are the risks that we take in this particular fund. So this is a unique category which can invest into large cap, mid cap, small cap, which can invest into equity, debt, gold, real estate, and it can invest into exchange traded commodity derivatives. So it can invest into crude oil, it can invest into cotton, it can invest into silver, all these kind of things. So you get an all-rounder in the form of multi-asset fund. So over here, I would like to end my presentation, which covered market outlook, which covered three important recommendations from ICICI Prudential Asset Management. That is ICICI Prudential Balanced Advantage Fund, ICICI Prudential Multi-Asset Fund, and ICICI Prudential Asset Allocator Fund of Fund. Balanced Advantage and Multi-Asset carries equity taxation, and asset allocator fund of fund unfortunately is not an equity taxation product. And recently, because of the changes in the indexation rules, it will be taxed similar to your fixed deposits. So there will be no extra advantage in the taxation part when we talk about asset allocator fund of.
Thank you so much, Bhavesh. It was a very informative session. I'm sure all of our viewers have taken some insightful information from this in order to help them make some very informed decisions. So, I have a bunch of questions here in the comments. So, I'll just start right off. So, we have a Tejal Kamre, and she asked, "How does gold help in multi-asset?"
How does gold help in multi-asset? Okay, good question. Like I explained, that gold also can beat equity in certain number of years. We just saw that particular chart where gold was the best performing asset class. And when in multi-asset, minimum 10% is what we have to allocate in gold at all point in time. Maximum we can go up to 25%. So what we do is we manage the gold between 10% to 25%. If we see that the gold valuations are looking great, or if due to a fall in equity or recessionary scenarios, gold can get elevated, we invest more into gold and other commodities like silver as well. And if suppose we feel that no, equity can do much better, then we increase the equity allocation, we reduce the gold allocation. As a result, we are able to generate the capital appreciation from gold as well. So it acts in a two ways. One, it will reduce the volatility of the fund when the equity is highly volatile. It will reduce the downside also. And two, it will give you that additional returns that you require to keep your fund at a good level.
Right. Uh, we have another question. Mr. Praful Khandar, the U.S. market is on extremely shaky ground. S&P is likely to fall and test 3,500 level again, or even below 3,200 level. How do you think the Indian market will respond to such an event should it happen?
Okay. So, see, there are a lot of hypotheses, a lot of thoughts going around. We always, as an investor, we always try to see what could be the worst thing that can happen and then plan our investments accordingly. So, I really appreciate this particular question coming in that if something like that has to happen in US, then how can it impact on the Indian market? So, two things can happen. One, that the recession that we are talking about in US, which is in a mild stage today, which might end going ahead as soon as the Federal Reserve stops increasing the rate, or it could get worse due to some unknown factors coming in. So if it gets better, then I don't think we should have any more problems. But if suppose it gets worse, then there could be temporary impact in Indian market as well, because globally we all are joined in this big web, and we cannot be immune to such impacts from one of the biggest economies of the world, which control most of the things. So definitely there will be impact, but the key word over here is the impact will be short-lived or a short-term impact. We saw in 2008 what can happen when there is a recession in US. The our markets also corrected by more than 50%. But we also saw that if we our fundamentals remain strong, then we can recover handsomely and we can continue to grow at a good pace. So similarly, today our fundamentals look very good. So even if there is any such impact which can happen going forward, as an investor, I would consider it as a big opportunity, because I'm sure if today we get a time machine and we are allowed to do time travel, we all would like to go back to 2008 October and invest our money during that time, because we understand that the worst period, the recession, was the best period for an investor to enter. And for investors, for their investing strategy, I would suggest use SIPs and STPs if you have any such concerns for the next 6 to 8 months, because this is the key period where the US Fed is very active. They might increase maybe once or twice, depending upon their inflation data. But this 6 to 8 months period is it. After that, post this period, I don't see any big recessionary scenarios coming in.
All right. Um, Rahat Maner asks, what are the differences between AAF and BAF?
So asset allocator fund and balanced advantage fund, like I explained recently, that these both follow a similar philosophy. Philosophy is to buy at a lower price and sell at a higher price. However, to do this particular thing, their execution is very different. Asset allocator is a fund of fund, whereas balanced advantage is a normal fund. So balanced advantage uses equity, debt, and arbitrage, whereas asset allocator fund, it uses equity funds, debt funds, and gold ETFs to do this particular thing. In balanced advantage, you can enjoy the equity taxation, whereas in asset allocator you won't get any such benefit of equity taxation. It is similar to how your FDs and bonds are taxed. In a balanced advantage fund, the range is 30 to 80%, but in asset allocator, the range is bigger. It is from 0 to 100 in both equity and in debt as well. Even the model that they use is different. So the valuation model in balanced advantage is price to book value, whereas in asset allocator, it is our in-house valuation index, the colorful chart that I showed. which
Mm.
I connected to traffic signal. So that is the model that we use in asset allocator. So both, although their philosophies are same, their execution is very, very different.
Okay, great. So I have some questions for you myself.
Yeah,
So, what is the range of rates in multi-assets?
it is from 0 to 10 because in REITs, there is no compulsion that I have to invest some or the other percentage. It can go as low as zero, but maximum it is 10%. We cannot go beyond 10%.
All right. Okay, another question similar to the second one. How did AAF and BAF manage the COVID period?
Yeah, great. So I had shown that particular chart which showed the average equity allocations in asset allocator and balanced advantage. So like I said that before COVID, both asset allocator and balanced advantage had less than 50% equity levels. So it was less than half invested into equity. So naturally, when the COVID fall came, so approximately 38 to 39% correction in the Sensex in the Nifty 50. At that time, balance advantage and asset allocator corrected less than 20%. So almost half the correction than your pure equity benchmark. So that was one thing
Mm.
protecting the downside. Second, our equity levels increased as soon as the markets went down because the model says buy at a lower price and the valuations were very low. So the valuation, the equity allocation in balance advantage went to 74%. In asset allocator, it went to 83%. So we increased the allocation sharply, and naturally, the market started rallying from the month of April. So we were able to capture a good amount of equity returns in the entire period. So to put into perspective, markets recovered in the month of November 2020. When I say recovered, that means it reached the pre-COVID levels in November 2020. However, asset allocator and balanced advantage recovered to their previous high NAV in August 2020 before the market because it corrected less and then it rallied. So that is the, you can say, management that happens in a dynamic asset allocation fund.
All right. I have a final question for you. How does BAF qualify for equity taxation?
Balanced advantage fund can manage the equity between 30% to 80%. So it can go to as low as 30%. Now, to give equity taxation into any particular product, we need a gross equity of at least 65% as per SEBI definition. Now, the question I am assuming here is that when the balance advantage goes to below 65% in equity, then how is it still managing to give us equity taxation, us as an investors? So what balanced advantage does is it uses arbitrage. So it keeps the gross equity at 65% all point in time. What it does is, if suppose I perceive the markets to be at a higher valuation, I use some hedging. I hedge some of the equity level and I reduce the net equity to less than 65, less than 50, less than 40. It can go to as low as 30%. So my hedged equity takes over. That is the arbitrage part. And by a combination of net equity and arbitrage, which is always at 65%, I never go below 65% in a gross manner. So although you will see gross equity 65%, but the risk might not be as high as 65% because most of the equity level over there could be hedged in nature. So that is how balanced advantage will always give you equity taxation, and you need not worry about the risk also because it can use arbitrage.
All right, Bhavesh. I think that was the last question for the day. So with this, we've come to an end to our session. I really want to thank you for joining us, and I want to thank our viewers as well. I hope it was worthwhile for you all, and hope you've got something from this session, something new that you have never heard before. So, with this, I want to thank you all for tuning into Yes Securities. We appreciate you signing in. I'm Anna D'Souza signing off. We'll see you next time.
So thank you everyone.